Good morning, ladies and gentlemen. Happy Sunday to you all. Hope you're having a wonderful weekend. And let me just reiterate, everything is fine. There's nothing to worry about. There's no bank collapses. No inflation ain't going up. Jobs market is cooling down. Everything is fine. Quick recap, guys, of the week that we just had. It was pretty tumultuous. You had ISM come in on Monday. Didn't really move the market because everyone was waiting for the big daddy of the week, which was the Wednesday FOMC meeting. We had factory orders come in below expectations, along with the job openings curled down a little bit, but the previous number got revised. So overall, just kind of a meh response to that. And then Wednesday, we had ISM as well, along with the FOMC statement and rate decision, where if you guys covered our live stream, you saw that we pretty much gave you the overall highlights, which was a bearish speech by Powell. He came out very hawkish, telling them and everyone that there was no rate cuts appropriate in 2023 and no decision on the pause or pivot, as a lot of people are terming it, was going to happen in 23. So we definitely, that was very, very hawkish, and the market kind of took it as the market took it, naturally went down. But then we had Thursday where everything is fine. Apple comes out, reports earnings, and everything's fine. But also we had the initial jobless claims come out on Thursday, where came in slightly below expectations, so adding more to that bearish news. But really, the key important thing was the payrolls, and this is where it gets tricky. We're going to talk about this in the debate section. So if you guys just want to skip to that part, everything's timestamped down below. That'll be just the talking head video part of the video. As you can see with non-farm payrolls, they got severely revised downwards from the previous week, which basically the market chose to run on a certain headline. It chose to run on the 165 number and being revised down from 236,000, disregarding the non-farm payrolls for this month because, the expectation could be it gets revised down like last month. So that all in summation, along with Apple's earnings, basically boosted the market to the upside. The NASDAQ actually closed a higher weekly high and had a wick to the top, but it didn't close significantly higher. However, it's still a progression. You're still fighting off the bears. And the S&P actually had a failed breakdown and failed break up. So as you can see here, he made a lower low on the week and a higher high on the week, but closed on the inside to the downside for the week on the S&P 500. So giving us mixed messages of what the market really wants to do, and basically is just a very tumultuous week, as I would say it. And we're going to go into the biggest winners and losers, guys, and then we're going to go over the key levels.
So with that said, let us now come into the S&P 500. Now, this past 5 days, guys, have just been absolutely bonkers. I mean, we had numbers coming out, we had the FOMC. It was just absolutely crazy. So the S&P 500 actually fell a significant amount on the 5-day. However, just as of Friday alone, this thing rose a whopping 2%, which is just absolutely crazy, all because, again, really strangely, the fact that the US added more than expected job numbers and unemployment actually fell. Now, history tells us that this means that the economy is doing really good, so the Fed should keep increasing interest rates. Yet, for some reason, the market went up. Don't know why this was the case, but nonetheless though, 1.85% overall. Looking at the heat map, we can see that there are a lot of red companies, mainly in the oil as well as the financials. Obviously, the financials make sense. The oil is very interesting because it's just weird. It's been falling for the past, or at least somewhat remaining the same for the past like 2 weeks or so. Nonetheless though, let's come into, guys, the technology sector, and we can see here that the best performer would be the company On Semiconductor Corporation, gaining 12.7%, and the worst performer would be EPAM Systems, losing 14.15%. Looking now into the communications sector, everything here was mostly in the red, all except for two companies, Take-Two Interactives and the best performer, which is Live Nations Entertainment, gaining 13.4%. Absolute insanity, guys. And, well, we can see that there's a lot of red. Worst performer, by the looks of it, would definitely be Paramount, guys. Look at this Paramount drop. 27.73%. I believe that they had really bad earnings, and Yeah, I mean a massive drop. We should probably take a look at this company to see if it's a pretty decent buy at the current moment. We should actually do that in a future video. Looking now into the consumer cyclicals. Very red sector, especially down here. Now, the best performer from what it's looking like would be the company RCL, Royal Caribbean Cruises, gaining 15.56%. And the worst performer is actually, this is actually really interesting. It is the company Etsy, losing 10.92% on almost 11%. Now, shout out to my two home improvement stores, Home Depot and Lowe's. Guys, Home Depot is down to $289. This is a company that I may actually buy some more and lower the cost basis. Now, Lowe's is a little bit more expensive at $205. I like it under $200 still though. Nice that we're falling when it comes to these two companies. Looking into now the consumer defensives. Very green sector. In fact, guys, the best performer from what it's looking like would be the company Molson Coors. That's actually hilarious because we just covered Bud Light and they have not been doing too hot. Now, they have not been falling to the rate that people were expecting. However, well, basically TLDR with that video, it is that the boycott that's currently happening with Bud Light, essentially, we're going to see that in Q3 when we see Q2 numbers. However, you can see that over here, Molson Coors is actually gaining a lot more than Bud Light in just the overall time frame that the boycott started. So the best performer is TAP, otherwise known as Molson Coors Beverage Company. And the worst performer from what it's looking like, guys, would be the company Estée Lauder, losing 17.5%. Coming now into the financial sector. Very red sector, guys. I mean, we all know what's been happening. PacWest, if you guys haven't taken a look at that, we got three banks are probably going to collapse soon. We got Western Alliance, PacWest, and First Horizon that are just completely crashing. So not surprising that this is looking this bad. But nonetheless though, the best performer would be this tiny company over here, Assurant, gaining 6.34%. Now the worst performer, this is going to be pretty difficult to find, but it is the company CMA, losing almost 16%. Looking now into the healthcare sector. Very mixed sector overall, nothing really too much happening. The best performer from what it's looking like would be the company, well, Eli Lilly, gaining 8.07%, and the worst performer would be, guys, the company Biorad Laboratories, losing 14.54%. And now coming into the industrials, very just mixed sector. Most of these actually are. Now the best performer is the company Generac, gaining 11.7%, and the worst performer would be the company Global Payments, losing 7.04%. Looking now into the real estate sector. This got twisted around. This was not like this before. Sometimes they twist this around. I do not know why. Maybe because a company got kicked out or something. Nonetheless though, 50-50, very 50-50. You can see that the upper half is pretty much like positive or slightly positive, yet the bottom half is very much in the red, except for Realty Income. Now the best performer is the company Host Hotels and Resorts, gaining 9.83%, and the worst performer is the company, it's actually two different companies, guys, losing the exact same. SPG losing 3.33%, and Vici, which also lost 3.33%. Into now the utility sector. Actually very green, which is actually surprising. Best performer would be the company ATO, gaining 3%, and the worst performer it is this little company over here, NRG, okay, losing 8.5%. Looking now into the ruby sector of the S&P 500, we got the oil industry, guys, energy to be exact, and everything here lost. Everything here lost. It wasn't a single green. So, you know, the best performer, or at least the one with the least amount of losses, would be the company WMB, Williams Companies, only losing 0.26%. However, the worst performer would be the company MPC, Marathon Petroleum, losing a whopping 12.38%. But guys, I mean, even the oil giants, Chevron and ExxonMobil, fell, 5% for Chevron and ExxonMobil 8.16%. So very red sector overall on the week. And lastly, when it comes to the basic materials, we got over here, guys, the best performer being none other than the company Vulcan Materials Company, gaining 10.54%. And the worst performer is the company MOS losing 8.73%. Overall, guys, on the week, this thing is just all over the place. Now, I'm going to show you guys what it was on the day performance on Friday, and yeah, very, very different. So if we didn't have a massive surge on Friday, you know, this 1 week performance would look a lot more red than what it currently is. After Friday, everything just gained a significant amount. I mean, pretty much everything is in the green. And I mean, you even have some sectors where everything was in the green. I'm talking like the banks, all of them pretty much gained. Like, all of them pretty much gained, except for one, which I just got right here. But aside from that, guys, you can see that overall, the Friday performance really brought the week performance up a significant amount. So, nonetheless, though, this is the S&P 500 1 week performance. So, with that said, take it away, Mike.
So, guys, we're going to start off with S&P 500. We just, like we told you in the beginning of the video, that you failed to basically do anything this week. You essentially went sideways, in my opinion. But for the next week, your range is basically going to be at 417.62 is where you need to break to continue the bullish run. And for the bears, you just guys keep moving the goalpost deeper and deeper in the red for you. You got to get below 403.74, which is going to be a very interesting point. But first, I want to see the bears actually close the week below 409.39, which is the 1 month look back on the S&P 500. Already looking at this, I'm seeing more defense than I'm seeing offense, where we're not advancing the chart, but we are defending. So you got to stop defending eventually to advance. So this week, in my opinion, is going to be pretty crucial for the push up. If you keep failing to make a higher high like the NASDAQ, we could see more downside potential, because eventually the defense is going to wear down and people are just going to just say, you know, screw this, I'm going to sell, come back. You know, the famous phrase, sell in May and go away. So definitely going to be something that we're going to be on the lookout for. If I jump into the 4 hour, as you can see, there is more bearish volume than bullish volume. You did have a big move up with a gap on the 4 hour and the daily to the upside. However, this could be one of those where we go up, we take the first cut, we go up, take the second cut, then we advance, or we're going to basically not have the second cut, we just waterfall straight down. So really, it's going to depend on those levels that we have for the week to tell us where we're going to be. Right now, we're basically range bound. If you look at the daily, it's not really that impressive. You did find support on this. You could be forming what I was calling a head and shoulders here, which is the pretty obvious pattern, which obvious patterns really don't play out. I do think you could initiate a bear squeeze. We're going to look at the net speculative positions for the week real quick, guys, just so we can talk about that. So looking at net speculative positions, you can clearly see you had some weak shorts capitulate out. Usually anytime you have a push, you see this trim back about 10 to 15K. So not something completely out of the ordinary, but there's still more net short this year than they ever have. And really, eventually in the short term future, you basically have to resolve this either to the downside or to the upside. One of these teams has to be right eventually, and we'll get a lot into like some of the black swan events in the debate section of the video. But just looking at this, you have a higher risk to reward to the downside, in my opinion. For the S&P 500, you have 1.2 to the upside versus 2.18 to the downside. That's a 2-to-1 risk to reward right now. So I'd be more in favor of downside versus upside. Now, you get above 415, 416 and have a daily close above that, then I'd be looking more to the upside, just because you're closer to birthing the bull, you're closer to getting up into this region that we've been talking about, and it's an easier play to the upside because it invalidates this pattern. Some of the things that I always talk about is price and volume. Right now, you can clearly see that there's more red volume than green volume on the day. So just overall, it's something that I'm going to be on the eye out. If we just see a continuation of green volume, then I would be looking more bullish. But it really, when I'm seeing all this defense here and how continuously we were having defense, it gives me reminiscence of this area that we were here, where we basically defended, and didn't advance the chart to get the first big cut down. Now, that was the SVB collapse happening right here, so black swan event, but you got the debt ceiling coming around now. So nothing is impossible, but 409.39, I think, is going to be your pivot point. Anytime you're below that, you have to look more bearish skewed, versus if you're on the the bull side, you have to be, when you're above that, you look more bullish skewed, and for continuation, maybe bouncing off this region for the second cut down to go upwards. But really, it's just very range bound until you break one of the SMAs, and we can actually go to that real quick here. Looking until you break 402.72, you really can't say that you're bearish on the market. You can be short-term bearish, but you can't really be long-term bearish. I would love to see these gaps filled over here. This has been driving me nuts. Leaving so many gaps on the chart is just begging to come fill those. And when we come fill those, we're going to probably be breaking the 50 and running to the 200 or the 50 weekly in a hurry. So we could get that this week. We could get it next week, but could not get it at all. It's been years since the COVID gap was formed. So, every gap doesn't have to get filled. It may get filled in time, but you can spend a decade waiting for that to happen. Now, jumping back over to the NASDAQ. Like we said, the NASDAQ actually closed a weekly higher high. Big, massive push up on it. Starting to tackle these upper prices here. Failed to actually hold the new high. However, failed to make a weekly lower low. So bullish and bearish at the same time. So for the NASDAQ, basically you want to get above 323.76 for your bulls. For your bears, you need to break it down below 315, and which is really ironic because you are actually going to the monthly pivot point. 315 has been a very, very crucial number that you've bounced around. So you pretty much got the ball set for you to come swing it back down. It would be a massive bearish engulfing candle if that were to happen. The problem is on tech that I don't see any red volume on the week compared to the S&P, which we did see more red volume there. You do have some red volume on the daily, but however, if you look to the left of it, you have more bullish volume, and now you're starting to possibly build more bullish volume. So you really don't have far in the risk to reward here. The S&P is not as great of a risk to reward versus NASDAQ. To the upside, you're at 0.38 to go, and to the downside, you got a lot more risk to reward. You got 2.36. So to me, it's basically, if you want to go bullish, you wait till the break above 323.76. So it's definitely going to be something that you're going to be on the lookout for there. To be bearish on the NASDAQ, I basically be looking for the rotation downwards. Breaking below 320 would be my starting point where I start looking bearish, but I still would have to be a cautious bear until we break 315. And let's just jump over to the dollar, VIX, and the yields, maybe to give us an indication of how other things are setting up, maybe show us some secrets hidden in there. So we're going to start off with the dollar. So the dollar has just been in this sideways consolidation for many, many days. As you can see here, you're basically building a coil that you could be winding up to the downside or to the upside. If you break to the downside, the market's going to have a massive, massive rip just because of how the things are inverted. And you could argue that this is basically a big bear flag forming here that is going to break to the downside, and I could fully agree with you. But it also could invalidate this pattern and rip to the upside. Remember, the dollar is pretty volatile. We saw this when we were coming back down here, and then pushed up. Same story, could be consolidating for the rip up. If we jump over to the weekly view of the dollar, we can clearly see that we're basically almost in no man's land, as I would call it. So if you get a rip up, I don't really see the strength in the dollar coming back, just because I think there's going to be a lot of fear with the debt ceiling that's going to kind of weigh down on it. But that's just my 2 cents in the matter. If you get a push down, basically looking for $100 to $99.78 being my area of targeting. For VIX, VIX has just had a very, very weird week. Massive push up, massive push down. So on the weekly, it basically did a whole lot of nothing. Actually ended green on the week, but however, you have a massive, massive doji, means you could have consolidation to the downside or to the upside. Remember, we have this trend line sitting here that brings VIX all the way down into 14s and 15s. So you could have the famous everything is fine, euphoric buying before the big rip. Now, VIX being back down into the 17s is more normal versus VIX being down in the 14s and 15s. When I saw that, I'm like, I don't think I should be betting with the market. I think I should be betting without the market, and just basically played the contrarian view for it for a short rip up. Now, Would I be longing anything or shorting anything long right now? No. I basically am going quick and out plays just because the volatility has a tendency to basically wreck your trade completely. Jumping over to yields real quick. 3-month continues to pay you 5.27%. It actually had a spike all the way to 5.5. So basically indicating for a short term, the bond market was pricing in more rate hikes from the Fed versus rate cuts. The 6-month again spiking to 5%. So basically saying that the Fed is either going to pause or to cut rates in the next 6 months. And then the 2-year basically just not really showing any strength. Anything outside of the 1 year or the 2 year is showing basically some disastrous event coming where the yield curve is going to start flipping backwards. And guys, we're going to talk about the yield curve in the discussion part of the video. So if you want to skip to that, feel free. But all the yields are basically saying, hey, something bad is coming. And with that, let's jump over to our news for the next week, where we're going to go over what is coming up in the following week. Monday, not a whole lot. We have employment trends, bill auctions, and consumer inflation expectations. That could be a market mover just because I've seen it before. However, I think the market's already on a preset course depending on what happens during the week. We have one of the Fed, Jefferson, speaking on Tuesday. That could give us, along with Williams, which is the one I'm going to be most likely paying attention to, just because he is the number 2 at the Fed right after Powell, where Powell basically listens to him. So his policy views and everything is going to give us a lot of insight. I think he's going to walk the line like Powell did, but it's always interesting to see if they give you that one little tidbit comment to see what they're thinking. Wednesday, we have Big Daddy core CPI and CPI year over year. Expectation to stay flat on the year over year. Month over month headline to actually tick up by 0.3% from 0.1 to 0.4. And then the core CPI year over year expected to tick down 0.1%, and then month over month to stay the same. Fair warning, guys. I saw this actually at 5.7 at one time and 5.2 for the year over year. They rise downwards, so they could be setting up a cherry picking scenario where they let the market rip up, and then, this number comes out. So just be cautious. We have had some time where we haven't had a disappointing result. We've had beats expectations and the market's basically ripped. So, there could be some psychological programming with that where, they just rug pull shortly just to flip the trade on someone. Never know. Now, don't take this as trading advice, just some things that I am observing. Then we have federal budget balance also on Wednesday. That'll be interesting to see if the federal government has any money left by this point. And then the core PPI on Thursday, which is coming basically similar to CPI. However, the PPI month over month is going from a negative number to a positive number. That's pretty staunch there, along with core PPI ticking down 0.1. Similar story to CPI. PPI month over month expected to go up significantly from negative 0.5 to 0.3, which now again, this 0.5 number could be a statistical outlier where we basically see it get revised to the upside, and then the year over year going from 2.7 to 2.5. I still don't know how much I believe that number, but then again, it's not what I believe. It's about what the market perceives it at and how the data comes out. Now, Fed Waller is also speaking on Thursday, so another person to keep an eye out. You got Bowman speaking Friday, but nothing much coming out on Friday besides the standard speculative positions along with consumer sentiment. So with that, guys, we're going to dive into the debate section of the video. Feel free to minimize the video or just use it as a talking point. At this point, we're not going to really be showing much. So I really appreciate you guys watching up to this point, and I thank you. If you guys could throw a comment down below of what you liked, what you want to see improved, along with if you throw a like on the video, it really helps us with the YouTube algorithm. And now we're going to get into the debate section of the video. All right, so now the first and foremost, the most important question, is everything fine?
Yeah, everything's absolutely fine. Yeah. Everything is absolutely fine. The economy's doing great. Banks are not collapsing in the slightest. We got massive job numbers, right? We got low unemployment. Everything's looking great, man. The Fed raised another 25 basis, 0.25 points today or just this past week. Yeah, everything is fine.
Nothing to worry here. Nothing to see here.
Nothing to see here. Go back to sleep. Go back to sleep. Everything is fine. Let me remind everybody that the reason why Silicon Valley Bank, FRC, and the other, I think, and Signature Bank went down was because of the fact that the Fed raised interest rates. Because when the Fed raised interest rates, that increases the rates of that increases the yields of the bonds, meaning that the prices go down. They just increased another 25 basis points. That means that the problem that caused those initial banks to fall to begin with is already, not only is it there still, but it's still persisting, right? That's the first thing. And the second thing would be, is that we just had really, really great job numbers with low unemployment. That means that according to the Fed, the economy is still doing good. Because their whole thing is we need to have high unemployment, because high unemployment means, according to MMT, that the velocity of money will come down because less people will be working. And that means inflation should come down with it.
Yep.
So everything's fine.
Now, funny you should bring up yields. I haven't looked at this graph in God knows how long. And
are you kidding me?
So everyone can see. The blue line and the yellow line is the federal funds rate. And when I say blue line, dark blue line. The 2-year versus federal funds rate of orange. But that's not really important. What's really important is this light blue line right here, teal or whatever. Okay, we're not going to get into the color debate. But most important thing is that blue line. This is the yield curve inversion. If you live under a rock or you never heard what the yield curve inversion is, it's basically the 2-year minus the 10-year, or the 10-year minus 2-year, depending on how you want to do it.
It doesn't necessarily mean a specific one. It just means that the lower years, right? The shorter years, the short-term bonds are higher than the long-term bonds. The yield is higher on the short-term bonds than it doesn't matter if it's the 2 and the 10. The 10 and the 30 can invert. And it's still considered a yield curve inversion.
But the traditional, what you'll hear in most articles, are they're comparing the 10 and the 2-year. So for the sake of staying consistent for this discussion, we're just basically talking about the 10 and the 2-year.
Okay.
Now, this is 2019, where the last basically inversion occurred. I'm actually going to snap a line, horizontal line to 0, just so everyone can basically know where 0 is. And, oh boy.
So what does 0 mean though? Like it's no inversion?
So 0 basically means that there's no inversion, and if TradeView would ever cooperate with me today, basically dotted line is 0. So in 2019, which most recent memory for anyone that's been basically trading or lived through it, if you were at that age and are trading now, you understand this, or if you're further down the line, you also saw this and probably saw many others. You basically came right to the precipice of inverting in 2019, where the Federal Reserve basically said, okay, we're going to stop. That was their last tightening cycle. So everyone remember what they broke in 2019, then going into COVID and all that stuff.
And then they used COVID as the excuse to decrease rates.
So all that combined, you basically, I'm going to snap another line to where we are now. And I'm going to make
I just love it.
A white line.
I just love it how in 2019 you tapped the 0 line and then it just fell.
Yeah, you panicked.
It's like it did like a little bit of a touch and then boom, instant crash.
Yeah.
And so as of now,
let's look back in history, because if everything's fine, banks aren't collapsing, we're not going to go into recession / depression / I don't know, maybe we create something new, a lost decade for all we know, or lost century.
Yeah, lost century. Yeah.
Hey. Yield curve never been inverted in history this much, but we got to peaking out at nearly 1% inversion that basically never happened in history, but nothing bad's going to happen because of that. And now with the Federal Reserve and the disconnect between the market growing significantly and yields, pricing, and different things, all that aside, you're at about a 0.5 inversion. Would you like to know where the dot-com bubble peaked out at?
I would actually like to know. Yeah, that's interesting. So let's do .com first, then 07.
Remember, 2019 or 0, which is where you invert, is the orange line. I'm actually going to make this a different color, just so it's much easier. Let's make this hot pink.
Make it like red or something. Okay, there you go, hot pink.
So, or whatever. So now we're going to go. So 2008, the great financial crisis, barely got about 0.2.
Wow, dude. Are you freaking kidding me right now?
Nope. This is actually how bad it is.
Can you zoom into that?
Sure.
Yeah, I want to see it. Look at wow. So how much was the peak?
The
At,
peak
2007,
inversion
2008.
0.2%.
Yeah, 2%.
0.2.
0.2.
Remember,
0.2.
you the white line is where you are now. Your max. Actually, let me snap back.
Hang on. That dotted white line up there. That's where you are now.
Yeah.
Wow.
I'm gonna snap. Let's make this orange.
And wait. We were higher too. That's insane.
So,
this is the first time I'm seeing this.
So
this is great.
So purple is 0, just for reference. White is where we currently are now, as of May 6th, 2023. I need to find a better color than orange because everything is freaking orange. The purple line, which is inversion.
Yeah, the hot pink.
White,
the hot pink.
The hot pink line is version. White is where we currently are, and where we peaked out is the yellow line, roughly at about 0.8, 0.9% inversion, nearing 1%. So here's the thing. There's a far distance between these two, and this is the great financial crisis. So the great financial crisis didn't create this bad of an inversion.
Wow, dude.
And now .com was worse.
Now go to the .com.
So let's jump over to .com. You topped out where we are now in .com.
And this is not even the peak either.
No.
From what we have right now. That's insane.
Your .com peaked where you are now.
Well, where you are right now, but it's not our peak right now.
No,
That's what I'm trying to say. Our peak is the yellow line up there. Yeah, that's insane. So hang on a minute. If that's the case, then what are we seeing now? A downturn when it comes to the curve, right? It's going back down to 0.
So let's go back to
wait. So if we take a look at the .com, right?
Yep.
What are we seeing? That as soon as it starts heading down, boom, what happens? The recession hits. Yep. The recession hits. Yep.
And right now you're basically stagnating.
Yep.
So now this is not a indicator of every recession. It's only indicated 15 out of 16. Well, not 100%. So, it's different this time, right? It's different. Till it's not.
It's not that every time the yield curve inverts you have a recession. Is that every time you have a recession the yield curve is inverted. There you go. So it's that kind of statement.
Yeah. So everyone wants to present the argument of we're going to create a new bull market. You would be arguing against many, many years of data to present this. And okay, so explain. I really want to hear an actual argument for this. And if anyone has it in the comment section below, throw it down there as well of why a yield curve inversion would not signify, or basically would the theory that every yield curve inversion signifies a recession on the horizon or a downturn. It doesn't. Is that a recession usually means that the yield curve is inverted. But just because the yield curve is inverted doesn't mean that we will have a recession. So there is some precedent, I guess you could say, for that. But at the same time, it's like you take a look at the last two, right? You take a look at the last two and what has happened. Yeah. So, but also it's indicated almost every recession in history. And the argument is, okay, so you're betting. We trade probabilities, right?
Right.
And you invest in probabilities. So you think the company is going to go higher, or the company is going to go lower. It's a probability
based on the past as well.
Yeah. So if I gave you a 90% certainty of something happening, are you going to bet on the 10%?
No.
There you go. So
absolutely not.
Yeah. So with the yield curve inversion, if you go back in history of every time it's got up here,
and you go back to the 80s.
The furthest this actually will go back is 1989. So this is going into.
But look, 1989 though. So that's the end of Volkner.
Yep.
So yeah, but
that was the second bounce.
But look at that. Yeah, it's the second bounce. Look at that spike right there towards that final drop.
We peaked out around that point. 0.5 has been a key area that it basically almost every big rip signified. But
right now we're higher.
We were
here. Higher.
We never been here in history where we were.
Right. That's
so
insane.
And the thing is you went up to here, you danced around and then we're bink and then came back down. But what shocks me is how fast you came back down to this. So now you're stagnating around the area that is your previous pivot point.
Yeah. By the way, what really bothers me about this whole entire yield curve thing, and I said this on the live stream, is that prior to the yield curve inverting, everybody, the media, let's just face it, the media, oh my god, the yield curve is about to invert. Oh my god, the yield curve is about to invert. Now, you don't hear anything.
Yeah.
Zero.
Because you don't want to stoke fear in the market, because the market's basically, we've seen the sell-offs in it that are a hairpin trigger, as I would call it, where you have any fear come back into the market, all the gains get washed away, and then you have this crazy swing to the upside because everyone wants to go back and FOMO into it.
So about that, let's go on to now. Why in the world did the market gain so much on Friday? Because that was insanity.
So the market and this is, I can't find any evidence in the jobs numbers.
No rhyme or reason.
So the only thing I can guess, and this is pure speculation, is the same reaction we saw with Meta that created the crazy 2% day is the same reaction we saw with Apple and Microsoft. Yeah. So Meta and Microsoft come out, beat earnings, market runs up, and it's like, okay, how'd those end? Sold it off back all the way back down.
Not even that. It's like, yeah, they beat earnings on analyst estimates. Yet, if you take a look at the year over year, it really wasn't that big of a deal.
Yep.
Like, it really wasn't. Like, that's why I always harp on things that's like, do not focus on earnings, because beating earnings, all that means is that they beat on what an analyst said. That's it. It doesn't mean that they're growing. Doesn't mean that they're going down. It doesn't mean any of that. So
it doesn't mean they're increasing dividends. Doesn't mean they're increasing cash flow.
Buying back shares. Nothing of that sort.
Yep. So let's just quickly run through. We already ran through jobs numbers, but if you look at this, just some highlights. Unemployment rate back down to 3.4%. Basically, the Federal Reserve is expecting 4.5 by the end of this year. You got a long way to go, but yet we're going to cut rates in September.
Yep. The pivot will start. Yeah.
I think I've upgraded. I need 2 liters of alcohol just to wash away the stupidity that these bulls are coming up with. Like, we were at 1, now we're at
Bud Light
2. No.
Bud Light.
No.
For anybody who doesn't know why I said Bud Light, is because, guys, we just put out and also on the live stream, we did the earnings for Anheuser-Busch. So if anybody wants to see that, make sure to go watch it on the channel.
Yeah, link down in the description below if you all want to see that. So
yep.
We also did cover Apple, so both of them will be linked down in the description below. But jumping back, non-farm payrolls, and I mean, if this was 2 months ago, this would have sent the market down 5%. If they saw doubling, doubling of non-farm payrolls, manufacturing payrolls, they said, hold my beer, and basically said they went from negative. But you know what they ran on? They ran on this being revised negative.
Yeah, but hang on a minute. Manufacturing payrolls, they were expecting a loss of 5,000 jobs.
Yep.
And they got a gain of 11,000.
Yep. And what it was is they were the negative revisions for the previous month. That's what the market chose to run, I believe. Wow. That in conjunction with Apple's earnings.
Wow.
So, it could be that they're front loading the data also, where they give you a more bullish initial data, because not a lot of people pay to revisions going back. But if you look, it's like the previous month revisions are always negative. So this was revised from 189,000 to 123. This was revised from 236 to 165. So basically equaling out the
I hate when these people revise it. It's just like, why can't you get it right the first time?
Because they gotta hide the numbers. If they don't like a number, they just revise it to something else.
It's ridiculous. So yeah, the market went up like 2% because like I just went over it, and yeah, it's absolutely massive. It's absolutely massive. Again, for what? Because as you said, last month, that with that non-farm payroll doubling what they were expecting, yeah, it would have dropped by 5% instantly.
Because the fear of the Fed basically doing what it's supposed to do,
which is raising interest rates.
Yep.
And now they have the tools to be like, economy's healthy, right? The economy's healthy. So that's just absolutely insane. And next week we have CPI, so that's gonna be fun as well. We're gonna have CPI for April.
Yep, they're expecting 5.5% on the yearly, And here's the thing. I saw this number at 5.2 and I saw this number at 5.7. So they revised this down lower from the close of the week. So, because now people are going to pay attention to this number. They're like, oh, no, we can't let these bulls see a positive increase in CPI. No, we can't have that.
Right. And then I hope that it comes in at like 5 or something like that. But honestly,
we're honestly overdue
we honestly
for a negative reaction to CPI.
Yeah, we really are.
It doesn't mean that it has to happen. I'm just saying, like, you've been hitting it out of the park for the past 3 months. Eventually, inflation is going to get sticky. It's not a line down or an exponential line down. It's even as bumps.
Yeah, but I believe last month when it got a 5%, it went down.
Correct. They had a well, you can dive in actually to the year-over-year number, see what it actually. Let's see. We were worse than expected. So they were expecting 5.2 last time. They got 5, so went from 6 to 5, jumping down. So now you're basically going to be stagnating at no change. So you went from 0.5% to this. So it's going to be interesting to see how the market takes this reaction. Are they going to basically say, like, oh, it was just a fluke number? Because, they're going to try coming up with any excuse that the number is fine. Everything's fine.
So, also, guys, I put out a community post asking everybody what you think the CPI number will be. So, if you guys have not voted on that, make sure to please vote on that. I really want to get as many votes as possible. And right now, people are thinking that it is near 5%, like around plus or minus 0.1% on 5. So that's very, very interesting to say at least. It'll be interesting, which, by the way, we will also have a live stream on CPI Day as well, because it's huge. It always is. So it's like our party pretty much, like, for every single month.
Yeah,
so
it literally is the party every single month.
Every single month.
So now, a perfect segue.
Go on.
The disconnect between the Federal Reserve and the perception that the market has of the Federal Reserve.
Well,
do you see that getting larger?
I mean, dude, let's just face it. The disconnect has been there from like a year and a half now, right? I mean, they have been calling for the stupid pivot ever since the bank. I think it was like the Bank of England said, we are going to pivot now. And because the Bank of England did it, people here were like, oh, the Fed will do it too. And it never happened. And I'm still waiting for it. The pivot narrative has been staying strong for some god reason. And I do not know why. It's just like, what kind of pivot? Even when Jerome Powell says, we have not even talked about, a decision has not been made on the FOMC meeting, he said, we have not even made a decision on whether or not to pause. Not pivot, we're talking about pausing.
Yep.
Like, and where is this pivot narrative coming from?
And then follows it up with a comment that rate cuts would be inappropriate this year.
Exactly my point.
I'm now like, imagine, I think he has to come out and do Jackson Hole again. I think he has to do the Jackson Hole speech again that he did back in August of 23. Because I think that's the only type of rhetoric that is going to get them that message through their thick skulls.
You know what I would love to do? Like, I wish if I could just have one power for 5 minutes. Just the ability to enter Jerome Powell's mind and control his body for 5 minutes. And then, actually, not even 5 minutes, 5 seconds. And then just say, we're bringing interest rates up to 20%. And then just see the fireworks happen.
No, it's like before he gets on stage, it's like, let me just buy my SPY next day expiration puts.
100 puts.
100 contracts of this.
100 contracts.
A couple thousand contracts of NASDAQ.
Yep.
All right, let's get out here.
Let's go. Interest rates 20%. Oh my God.
The committee decided that it was appropriate to raise interest rates to 20%, 2,000 basis points.
Yeah, 2,000 basis points. It's starting immediately. Oh my God! Could you imagine the fireworks? Oh dear Lord, market would fall like 200%. Like overnight.
You would have a flat. You would just hit the circuit breaker instantly.
Yeah,
but that's the bear wet dream, as I will call it. But the thing is, the bulls have a wet dream too. They think that the Federal Reserve is going to pivot when he's coming out and saying there's no case for that.
Stocks only go up.
And here's the thing:
buy the dip mentality.
So we've been talking about that. The crash leg is always spawned by a black swan event, and what more perfect black swan event than two political parties going at it and having less than 30 days to negotiate a debt ceiling, where literally you have 43 Republican senators, meaning senators, where you have a slim majority in the Senate, where even if the House were to create something, this is the Senate, guys, remember. This is not the House of Representatives where you have a different majority or you can sway it. You only have a set amount of people, and there's basically half the factions are just deadlocked in what they do, and then you got a slim majority in the middle that kind of wavers back and forth. 43 Republican senators led by Senator Mike Lee of Utah said they are united behind the House Republican Conference in supporting a spending cuts and structural budget reform as a starting point for negotiations on debt ceiling. QEE basically saying you can take your clean budget bill and shove it where you know where.
And now, also, guys, hang on. Before we do anything else, we're a financial channel. We're just talking about this because it is important to talk about.
Yeah.
Add on top of that the fact that the House is the one that controls the purse strings. And the House right now is probably super, like, razor thin margin. Razor thin margin. So unless the House and the Senate can agree to this, I don't see any form of debt ceiling being signed.
Yeah. And
I really don't.
And wherever you lie in politics, that's not the problem. The problem is the perception the market's going to have, because you got to think about this. Remember, you're in the business of making money. What does the market do? The market takes the future and makes it now. So if the market decides to price in that these two idiots over here, and I say idiots for a reason, can't get along, and basically create a budget or negotiate something or agree, right? These two mongrels have to agree to something, and my entire financial stability is dependent on them. So I'm going to sell everything because I want no partaking in this. Remember, the market's risk adverse. If the market thinks that debt ceiling's a reality, like, you know, CPI is there to distract them. After CPI is done distracting them, there's nothing left, guys. After Wednesday, the debt ceiling is the issue. PCE cannot hold a candle to it.
Nope. Absolutely not. And it's gonna be really hilarious to see when the world happens with this, because this is a major problem. Obviously, if the debt ceiling if a bill cannot be passed based on, like, regarding what to do with the debt ceiling, then the government would just be shut down. Now, my personal opinion, it should stay shut down, but that's me. The fact of the matter is that markets will probably not like that.
Yep.
Probably not. Right?
The bond market would absolutely turn itself inside out.
Oh, absolutely. Absolutely. So it'll be very, very interesting to see this whole entire thing when it comes to the debt ceiling. Because, yeah, aside from CPI next week, there really isn't anything else. When is the debt ceiling
run out?
Like, yeah.
So,
like, when is the last day?
This is where you guys know some of our views that we don't believe the government can account for or do anything correctly. So they can't even tell us a date correctly. They've been moving this date around till no end. So originally it was August, then it was July, now it's June. They thought it was May, then they went back to June. So it's like, flip a coin at this point. Flip a coin, pick a random date, put it on a dartboard, throw a dart.
All right. Yeah. Personally, yeah. I just, when this starts getting close, you know when?
So the date that's floating around now.
No. Hang on. Do you know when the debt ceiling begins to come close? I'll tell you when.
All right.
When the media just starts screaming at the top of its lungs, and all you hear on every news is debt ceiling. That's when you know.
You're starting to see that now.
Right, you're starting to see that now, but I'm saying you don't see that prominently.
Okay.
That's my point.
Because you had the Federal Reserve meeting and you have CPI. All right. I like that theory. When everyone starts screaming at the top of their lungs, that's when it's coming.
Yep. And then the whole bank situation will all be in the past. Is no longer having any bank situation, and then the new thing would be the debt ceiling.
So
and then the debt ceiling passes, and then another bank falls, and then we're back into the banks. That's
funny. What happens if both happen at the same time? What if they're deadlocking negotiations and banks start falling? Because PacWest.
PacWest gained 80%.
Well,
on Friday,
and still didn't close above the 2 days before.
That to me is insane. That just
Well, no, it
insane.
just shows like compounding losses. So you have to have a
Right.
double your win
Double your gain.
Double your gain.
To get that
to break even.
To break even. Not
Like,
even
if you look
gain,
at-
just to break even. Yep.
Yeah, look at Western Alliance. Down. Now these banks can recover. I'm not saying they can't, but
Yeah.
looking at
So did
PacWest's
FRC though.
history and
Yeah,
what
but-
they said, it's identical to FRC. You're seeing
Yeah.
volume increasing. It's just a matter of time. Like
These banks can recover, but guess what? So could FRC, and we saw where that ended.
Yep.
So I mean, sure. Is it possible? Yes. Is it probable? That's the different story, and you guys need to take a look at what's probable, not what's possible.
Yep.
So it'll be very, very interesting, man. CPI is going to be a major event, like it always is. Now, obviously, we will live stream it, so make sure to catch the live stream, guys. It'll be on Wednesday. What time do you want to make it? 6 p.m.?
6 p.m. Yep.
6 p.m. Yeah, the sooner the better. So 6 p.m. on Wednesday, May 10th. And yeah, we're just going to cover the live stream, and we might even cover a couple of earnings as well. Because there are a few companies that have earnings on Monday, Tuesday, Wednesday. Most likely Disney. We'll cover Disney. And even, I would say, like Tyson Foods.
Yep.
And Occidental. Probably just those three. We'll see. But yeah, we're going to take a look at the CPI. We're going to take a look at a few earnings. And that's pretty much going to be the live stream. But guys, in accordance to this video, yeah, man, this is going to be crazy. I don't know. Like, you started this segment being like, is everything okay? No. But it hasn't been okay for a while.
Well, where I think you hit the nail on the head is when the media starts saying everything's not okay.
Yep.
Is when things really start breaking down. And
Well, I meant more of that regarding the debt ceiling. I don't think the media will ever start.
I think you can apply it to almost a lot of the things. If the Black Swan event, the debt ceiling,
True.
And, just insert cause here, and you can use that as a gauge.
Yeah, 100%. Well, anyways, guys, I think that would pretty much do it for this video. If you like, comment, subscribe. It really does help with the algorithm on YouTube. Y'all can follow us on the new tech sites. Link is in the description below. So with that said, peace out, and we'll see you all next time.